Hi, Professor Rex here. In this week's video, I'm going to focus on the simple tech stock portfolio my accounting students and I started in April of 2024 as outlined in red. I'll also talk about three new strategies I'm experimenting with: capital light companies and wide moat stocks, which is a simple way to ensure that you're only investing in companies with the strongest competitive advantages. And we'll also talk about a sector rotation strategy I'm trying for fun. And if you're interested in the dividend growth stock portfolio on the far left, I started a completely free Substack featuring that portfolio to see if I like the Substack platform. You can sign up and see which dividend growth stocks we're buying in real time on Mondays. In that same Substack, I've been posting the capital light and wide moat stocks that we've been buying. Let's get back to our tech stock portfolio outlined in red on this slide. It's a real-world investment portfolio where I make additional investments on the first trading day of each week. It's by far our most volatile portfolio because it's not diversified, since it only invests in one sector, and tech stocks, by their very nature, tend to be very volatile. Also, it's our newest portfolio, so its performance will fluctuate up and down more so than other portfolios which have longer track records. Now, our tech stock portfolio so far has an annualized return of 28.4%. In next week's video, we'll talk in depth about our dividend stock portfolios that my accounting students and I started back in 2022 and 2023 as outlined in yellow. Like our tech stock portfolio, they are real-world investment portfolios where I make additional investments on the first trading day of each week. So in effect, they are accumulation portfolios mimicking someone in their working years who is consistently adding to their investment portfolios. And as a reminder, the portfolios on the right in the light blue outline are portfolios that I started in 2003 when I was in college. These portfolios are more buy and hold portfolios with infrequent trading, so their lack of action might make for boring videos. So you can go online to beatthestockmarket.com to read more about them if you like less frequent trading. So here's a summary of our investment strategies, their annual returns, when they were started, and where you can find them. The dividend strategies are my personal favorite, since my goal is to generate passive income that is twice my annual expenses. The dividend growth stock portfolio seems to be the most popular, so I put it on Substack for free as an experiment to see if I like the Substack platform. I may eventually switch completely to Substack. You can find most of the strategies on my website currently, beatthestockmarket.com, but if you can't afford a subscription, I alternate my weekly YouTube videos showing you the dividend stocks we've been buying one week, and then in the next week's video, I show the tech stocks, wide moat stocks, and capital light stocks we've been buying, as well as information on our sector rotation strategy that I've started this week. Now in the green box in the upper left, note that I've added a note that the tech stock portfolio and capital light strategy are both newer, and therefore the average investment has been held for less than a year. This means their annualized returns can fluctuate a lot until the holding period eventually grows. For example, the capital light strategy is by far the newest, as it was started in February of this year. The average investment in the capital light strategy has only been held for 75.2 days and has a return of 10.45% over those 72 days. The annualized return of 62.04% should be taken with a grain of salt. All it means is if a stock's price increases 10.45% every 75.2 days, the annual return would be 62.04%. So just be aware that the annual returns of these two newer portfolios jump around a lot, but will settle down over time. And in the purple box on the bottom of this slide, I've broken out the dividend-paying tech stocks versus the non-dividend-paying tech stocks. Turns out that so far the dividend-paying tech stocks have been outperforming the non-dividend-paying tech stocks, as the dividend payers have been averaging 38.74% per year. That's good news for us people that like dividend-paying companies. Now here's a weekly chart of how our weekly investments into our model portfolio of tech stocks has been growing. It's as of last Friday. We invest $12.50 each week and buy 10 different tech stocks on the first trading day of the week. And the ratings for our stocks change weekly, so the list of stocks we buy each week fluctuates. And on my own, in my other separate retirement accounts and brokerage account, taxable brokerage account, I'm also investing in these different strategies. So it's not just $12.50 each week. So here's the usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own due diligence. And due diligence is just a fancy way of saying do your own research. So now in our last video about tech stock portfolio, about our tech stock portfolio. I forgot to say that we sold CrowdStrike Holdings, which now appears to be fairly valued, while its two-way rating of valuation / company's future outlook and quality has fallen to the bottom 22% of companies. CrowdStrike provided an average return of 70% for our multiple investments in the tech stock portfolio, with an average holding period of nearly a year. So let's talk about the tech stocks we bought last week. On this slide are our ratings for the top 15 tech stocks as of last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday. Then we purchased the top 10 stocks. Note that all these stocks are higher quality, meaning they must have a quality ranking of B- or better. More on what makes up that quality grade on the next slide. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend growth stocks, because some tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc. So our highest rated tech stocks last week were Adobe, Motorola, Salesforce, Apple, Workday, Microsoft, Arista Networks, Analog Devices, EPAM, and Taiwan Semi. So here's the same stocks, but this time we're breaking out the components of our quality grade. Quality-wise, again, we only invest in stocks rated B- or better for this portfolio. Risk is the first quality component. Tech stocks, by their very nature, tend to be riskier than most other sectors. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. Remember, the risk rating here is comparing these stocks to other stocks. It's not comparing it to other investments like bonds or CDs. Now, this slide shows our best performing tech stocks in our tech stock portfolio since our last video about tech stocks, which was 2 weeks ago. The portfolio has had a huge comeback after being hit hard in April by the tariff announcements. The best performers in the last 2 weeks are Arista Networks, up 18.72%, Synopsys, up over 16%, Applied Materials, Taiwan Semi, NXP, NVIDIA, Broadcom, Shopify, and Lam Research. Now, one reason why tech companies have been outperforming this market for several decades might be because they tend to require little capital. As a simplified example, if you want to start a software company, you just need a computer and software knowledge. On the other hand, if you want to start manufacturing cars or jets, you're going to need a lot of buildings, a lot of equipment, a lot of employees, etc. In other words, a lot of capital, which is very expensive to obtain and maintain. Now, Goldman Sachs recently published a research note that shows that companies that do not require a lot of capital have significantly outperformed companies that employ heavy capital by 544% during the period of 1990 to 2024. The research calculated capital intensity based on 3 formulas: assets divided by number of employees, assets divided by net income, and capital expenditures divided by net income. After finding this research note, I contacted the authors and discovered we might be able to get even better results, because in the study they ranked and classified companies based on the 45 sectors of the ICB taxonomy, not based on individual companies. So not only did they only look at the sectors, they took the sector's median since 1990. So if the sector's capital intensity changed over those years, they ignored that. The authors admitted that sectors that were once capital light can become capital heavy and vice versa. And they admitted that within a given sector, one company may be capital light while another is capital heavy, but they ignored that too. I'm assuming they did this to save time, because otherwise they would have had to look at each individual company's factors for each month or week, and then do this for each and every year in the study, which is a lot of work when you're looking back over 30 plus years. So it seems their study could have had even better results if they dug deeper and looked at companies specifically instead of sectors in general. And we can do this in real time going forward on a weekly basis. So that's what we've been doing, looking for individual companies that are capital light, but also high quality. And our capital light rating is based on individual companies, not whole sectors or industries. So on this slide, I have a list of S&P 500 companies that are capital light, high quality, and appear to be undervalued using a growth methodology. These are the capital light stocks we bought on Monday for our capital light stock portfolio. Similar to our high yield stock portfolio, we're using two strategies for this portfolio. Strategy 1 in red, as you can see right here, ranks 1 through 5, emphasizes how undervalued a company is, while strategy 2 in green, down here, emphasizes not only how undervalued they are, but also their quality. So far, the portfolio is ahead of the S&P 500, as we saw early in the video, but it's very early in using this strategy. So for this slide, I started with a list of over 4,300 companies, and the first step was to filter out the companies that were capital intensive based on the 3 formulas that the authors used in the study. Now, here's a strategy I started tinkering with behind the scenes in September of 2023. It's not the most diversified portfolio, so I decided to wait longer to share the results. It's a wide moat stock strategy. First of all, what is a moat? Well, Morningstar is a service that rates stocks and is famous for its moat rating that it assigns to large companies. What's a moat rating? A moat rating attempts to simply measure the competitive advantages of a company. If a company has no competitive advantage, then it's easy for another company to enter the industry and take customers away from that company. They call it a moat rating because they liken it to a moat around a castle. If the moat around the castle is wide, then it's hard to storm that castle. If the moat is narrow, then it's a bit easier to attack the castle. And if there is no moat at all, then the castle is much easier to attack. So this strategy invests only in companies with the best competitive advantages, in other words, the widest moats, hence the name wide moat strategy. There are limitations to the moat rating, and I prefer my own quality ranking system that takes much more data into consideration, but the moat rating is kind of a quick shortcut way to invest in only high quality companies. On the next slide, you'll see me ranking for the top 15 companies with wide moats, but first let's look at the strategy's performance. Like the tech stock portfolio, I've been making weekly investments into the portfolio. I originally had this strategy in a Fidelity portfolio with a few other strategies, but quickly learned that having several strategies in the same account makes it a nightmare to track their performance separately. So I sold off those holdings and have since started a Fidelity account dedicated solely to this wide moat strategy. The average investment so far has been held for less than a year and has produced a total return of 18.94%. Using Excel's rate function, that's an annual return of 52.92%. Now, the strategy does not result in a portfolio with as much diversification as most of our other strategies, so the portfolio's performance could fluctuate a lot. And the performance likely won't stay quite that high because stocks historically average a total return of about 10% per year. Now, Morningstar offers an ETF that only invests in wide moat stocks. So that ETF is a natural benchmark or comparison for this strategy. Its ticker symbol is MOAT, M-O-A-T. If we'd instead invested in MOAT on the same exact days, we would have received a return of 10.27% with the same holding period. Using Excel's rate function, that's an annual return of 27.05%. So our wide moat strategy has nearly doubled the annual return of the Morningstar ETF so far. This strategy is also beating the S&P 500 by 19 percentage points on an annualized basis. Now let's look at a ranking for the best wide moat companies. In other words, companies with the strongest competitive advantages. The valuation method uses a growth methodology, not a deep value methodology. Now, unlike our dividend growth portfolio where we want lots of diversification, for this portfolio we've only been buying the top 5 stocks each week, and we don't limit how much an individual stock can be in the portfolio. So this portfolio is less diversified and more aggressive than our dividend growth stock portfolio. Remember, stocks in any of our strategies may appear in the list one week, but not appear the next week, as they might barely miss a screening criteria such as earnings estimates over the next 12 months, which changes frequently. And just because a stock falls out of the ranking one week rarely means that we plan to sell the stock. Sales are kind of rare. The 5 companies we bought last week are Constellation Brands, Copart, Etsy, Salesforce, and Thermo Fisher. Now, the portfolio is very concentrated because we only buy 5 per week. And I'm a big fan of diversification, so I'm thinking about increasing the number of stocks each week from 5 to 10, but employing 2 strategies. One that buys the 5 most undervalued stocks, and a second strategy that equally weights quality along with valuation. Now, one advantage of companies with the best moats is if they pay dividends. They are more likely to increase dividends, even during an economic shock, when compared to companies with no moat. Now, on this slide, Morningstar shows there are three categories of moats. On top, we have the companies with the wide moats, which is considered the best. This slide shows that during the 3-year COVID period, when supply chains ground to a halt and some companies saw a collapse in sales, about 80% of wide moat companies were able to raise their dividends despite many companies being in financial trouble. Only 18% or so cut their dividends. Now, for companies with no moat, which is on the bottom of the chart, only 57% or so were able to raise their dividends, while over 30% were forced to cut their dividends. For that reason, many of our strategies only invest in companies with either a wide or narrow moat. While our quality ranking for stocks includes moats, it goes much deeper than just one metric. But if you want a simple metric for quality, moats are a good place to start. Of course, this slide only covers the 3-year COVID period. Now, during normal periods, dividend cuts are much more rare. And on average, companies increase their dividends 5.5% to 6% per year historically. Now let's talk about a strategy that is a sector rotation, or you might even want to call it an industry rotation strategy that I started experimenting with using real investments. Now, the Center for Financial Research and Analysis suggests sectors to overweight and sectors to underweight. Overweight just means you put you invest extra in those sectors. Underweight obviously means you invest less. Now, currently they have an overweight rating on the communications sector, financials, and information technology, also called the tech sector, as you can see in green. They claim that they have a sector rotation model portfolio that is based on the sector weighting recommendations seen on this slide. The portfolio has a 30-year trading history. Since its inception in 1995, the sector outlook model has had a 63% hit rate, which I assume means it beat the S&P 500 63% of the years, and has outperformed the S&P 500 index by 4.4 percentage points on average per year. Now, does that mean they only invest in the overweight sectors, or do they just allocate more to those sectors? I haven't found out exactly yet. I need to look deeper. And also looking deeper into these sectors, I noticed within each sector, they have outlooks for each sub-industry within the sector. For example, even though they have an overweight recommendation on the communication services sector, only 30% of the sub-industries within the communication sectors have a positive outlook. In other words, could we possibly do better than the 4 percentage points per year of outperformance if we only invested in these positively rated sub-industries? So let's break out one of the sectors on the next slide. So this week we're looking at the consumer staples sectors. There are 12 sub-industries in the consumer staples sector, as you can see on the left side. We also have the outlook for each sub-industry, and this week I added the largest S&P 1500 constituents in each sub-industry. Now, currently, 2 sub-industries in this sector have a negative outlook: agricultural products and services, and packaged foods and meat. You can see that in red, the red negative. But one sub-industry currently has a positive outlook, with that being the consumer staples merchandise retail. Now, the largest company in that sub-industry is Walmart, followed by Costco, Target, and Dollar General. So the various ways one could implement a sector rotation strategy is pretty fascinating. And since it's summer and I've got extra time, last week I decided to give it a try. I started a new brokerage account. I funded it and invested in these 10 stocks. The first criteria being that the sub-industry must have a positive outlook. They also must be high-quality stocks. So each week I'll be adding more funds and buy 10 more stocks depending on the rankings that week. The 10 sectors in positively rated sub-industries last Monday that I bought are Royal Bank of Canada, Intercontinental Exchange, Visa, MasterCard, MSCI, Adobe, Canadian Pacific, Yum Brands, Motorola, and Air Products and Chemicals. So it'll be interesting to see how we do, see if these positively rated sub-industries can outperform the market. That's it for now. In the comments, let me know if you have any questions, and also let me know what investment strategies you would like to see more of. or if there's a particular sector you would like to look at next time. And finally, here are the places you can reach me. YouTube, obviously, as well as our website, beatthestockmarket.com, Substack, LinkedIn, and Twitter. I'll see you again next weekend, likely with a list of the dividend stocks we will have purchased on Monday. I hope you're having a great 4th of July holiday weekend. See ya!